I'd like to introduce the host and our first speaker for today. He's been in real estate for over 30 years now. How's that feel? As a hard money lender, builder, realtor, real estate investor with over 2,000 transactions, best known for his long-term market trends and timing reports, a host of award-winning radio show, and this year we raised 80 grand for Susan G. Komen through our I Survived Real Estate event. Many of you, which were there, thank you very much. Bruce Norris.
Thank you. Well, good morning. Can you hear me okay? Yes? Okay. Well, thank you for coming. This is going to be a very special day. Most of the time you hear me speak, we're talking about how to make money. And today is going to be one of those days where we talk about how to keep some of it through tax planning, through understanding maybe a better place to put the money, and then at the very end of our lives, how to have it go to our heirs and maybe to our charities of our own choosing rather than to the government. And so the people that we've selected to share this day with are here because while I was listening to them as a student in an audience, I learned something I did not know. And when you're in the business for 30 years and you really try to stay on top of things, when you have a few of those aha moments yourself, you realize, you know what, these people really know their stuff. So that's who's going to be in front of you today, and so we're really excited about the next few hours that we get to spend with you. Most of you know me, but president of the Norris Group, and Aaron, I'm so proud of him when he talks about we win awards. I didn't even know awards existed for the categories that we've won them in. So this is all a lot of his brainchild. So he's been such a fantastic addition to the Norris Group. So if you think, boy, this is a nice event, it's mostly his fault. And so I get to enjoy a lot of those results. The Norris Group is basically still a property buyer. We probably bought about 120 properties this year. And what that does is allow us to keep in tune with the marketplace. And we also have a loan business where we fund other investors' deals. And we've probably funded 300 plus loans this year. Some of those loans are for rental properties. So we have a long-term investment program, which we'll be talking about today. We have an education program where we teach investors what to do, how to change and shift gears as the economy changes. And I guess that's my biggest job, is to read the next book or report that helps me decide the direction to send my own company and then share it with you what I think is next. The Nixon Library event is a very special event. And what it's gradually done, the radio show has gradually put us in front of a higher and higher qualified guest audience. And that's the way it works. You know, when you first have a radio show, you ask somebody to come on and they look at your guest list and go, okay, well, why would I take the time to do that? And then as Aaron gradually has gotten us up the rung of the ladder one step at a time, all of a sudden now we can ask a lot of very influential people on the radio show, and they look at our guest list and go, I guess that makes sense because so-and-so has already showed up. And so that's been, it's been a process. Aaron has been responsible for even talking to Warren Buffett's secretary. And Warren Buffett has the California crash report. I don't know if he's cracked it, but Aaron got it to him with that lady saying that he would at least receive it. So Aaron's done a very good job with all that we do. Now this is going to be exciting if this doesn't work. Aha. Where do I point this to get it work? Okay. This is our basic business model, is that we're involved with people that take this house and turn it into this house. And this, by the way, is one of our rentals. And the problem for California is that this property sold for $436,000 at the peak, and we bought it for just a tad less than that, $65,000. We took $35,000 to fix it, so we have 100 grand in it. We rent it for $1,400 a month. And it's just one of those rare times that actually makes sense in California to hold rentals. It hasn't always been so, but right now it does. And one of the things that our challenge is that, and I'm going to show you the statistics, that it's inevitable that we will have declining home ownership and we're going to have more rentals. And the cities are very, very nervous about that because they assume slumlord equals what we're going to own. And that's not necessarily true at all. And that's part of our effort as we talk to cities, is for them to understand that this is not what happens when investors touch a property, that they actually improve. Okay, I am having trouble with this. The interest rate chart, all-time low. I saw an ad or a news article, and it's probably the first time in history it's ever ran. It said interest rates move back over 4%. When would you have ever seen that before? So this is a very unusual time. So if you're borrowing money, it's a fantastic time. What if you have $1 million and you want to get yield? It's just the opposite. You know, you'd like someplace safe for it to go, but you're either going to risk principal or get nothing on your money. And that's the challenge that we're trying to help today, is some alternatives that are very safe and things that you understand. You know, sometimes I talk to investors and, where's your money? And it's in some foreign stock market, and they're just going, wow, it just seems so uncomfortable to me because I don't have a clue how things work like that. So what's resulted in those interest rates being down and prices being down is affordability being sky high. So usually when we look at this chart, we talk about affordability in the sense of being a homeowner. So homeowner, yes, your payment is an all-time record in relationship to what you make. But the rentals are also the least expensive cost per month that they'll ever be. And that's one of the reasons we've been trying to talk to Fannie Mae and Freddie Mac and FHA. We were invited back to Washington, D.C. I was there with 3 other investors. One of those was Sean O'Toole. And we spoke in front of the people that make decisions for Fannie and Freddie and FHA. And I came away with a clear understanding that common sense, if common sense were going to rule, the decisions could have been made that day in the right direction. However, that's not apparently how things work in Washington. So what I came away with, understanding that the private loan business is going to always need to exist, because there's just not a way to do things in a fast manner in Washington. The politics will always get in the way. So even though these things are most affordable and investors should be getting financing in a more standard way, I don't know that's going to come in a big rush or in the quantity it's necessary. So there's going to be private loans, and we're going to borrow money at different rates, and it's still going to work. What I'm going to do is start building a case for you to understand how ownership has no choice but to go down. And this is not going to be a long-term trend, I don't think. But it definitely is going to be one that's going to be with us for, say, 3 to 5 years. One thing is unemployment. When I did the studies about how boom and bust cycles work in California, this is a very important initial domino for things to get better in California. So we have to have employment improve. We've never had employment improve unless building was a participant and maybe even a leader. The problem is you can't build anything right now in very many areas in California because the price per square foot it costs to build exceeds the price it'll sell for. So we have to solve another problem first. What do we do with all this real estate? And so this unemployment is going to stay high for a while because we don't really have a way to solve construction yet. The foreclosures, this is a chart over a long period of time, and they ended it purposely in 2008 because it's usually very symmetrical. Foreclosures are what I call a reactionary chart. There's things that happen and then that causes foreclosures. And in 2008, we had the ridiculous quantity that we ended up with. 2009 should have been off the chart and on the ceiling. But we managed to pretend that wasn't necessary, that we didn't have to foreclose on properties. But you have all these people that are unemployed, you have all these people that are in foreclosure, and you start adding up all these piles of people and figure out who your next buyer is and how qualified are they. And you're going to come up with an answer that they're not very. Can we move forward? Okay. Most of you have seen this chart before. This chart in brown shows having not luck here. Okay. This chart here shows people that have stopped making their payment. They're delinquent. The gold chart shows trustee sales. The brown chart usually precedes the sale chart by 2 quarters. So a mathematical relationship would be 4.2 is to 1.2 as 11.3 is to 0.8. Does that make sense to you? Okay, so something went just a little wrong. And what we decided about here was, and this was really close to where I bought that $436,000 formerly worth $436,000, $465,000, is they had dumped a lot of inventory into the marketplace at one time, and the lenders were getting about 15 to 18 cents on the dollar for what they were owed. And I guess that got kind of painful. So they just decided maybe we shouldn't foreclose on these, and that's what started happening. This is the chart that we should have experienced. So California has a lot of unresolved properties, and you also have all these people with still damaged credit that aren't going to be in a position to buy a property for a long time. This is an interesting chart. This is nationally. This gold number now is 31%. 31% of loans in foreclosure have not made a payment in over 2 years. If they had foreclosed on those people a while ago, they literally would be emerging as buyers in the next 12 months. We've prevented that. So in trying to stop the problem, we've actually elongated it for a very long time. So we're going to pay a price for that. There's also definitely a move in things that you read about downplaying home ownership. When it reaches the front cover of Time magazine, Rethinking Home Ownership, Why Owning a Home May No Longer Make Economic Sense. That's not something I was raised with. When I was a young man, that was the only thing you wanted to do was save up your $2,000 and get a house. And now it doesn't make economic sense. I would love to debate on that subject, by the way. I can't imagine prices are half, interest rates are 4%. The payment that emerges is an all-time low, and you'd rather me be a renter for 30 years? Wow. That's just astonishing. But that has influence. And so you're going to definitely have people go, well, and we have it all the time. We have escrows that fall out for no other reason than people are fearful if they're making a bad decision. And so the property falls out. This is Raphael Bostic, Assistant Secretary for Policy Development and Research. This is for HUD. There's a notion that being housed well is synonymous with being a homeowner. That narrative has got to change. What is he saying? It's perfectly okay to be occupying a rental property. And I have nothing against renters. I've been there, but it's not the end goal for most people. And now he's kind of saying that narrative got to almost be on an equal playing field. And this is a policy maker. I met him in Washington, D.C. I really liked him. And I think he understood how to solve this, but I don't think he had any way to do it. When we were doing the presentation, I went first, Sean went second. I was going to finish up, and he looked across the table from me. He said, just so you understand, he said, I basically completely agree with everything you're saying. So there was no need to go further with the presentation. And I looked across, I said, are you telling me that I have to help you convince whoever you have to get something done? He said, yes. And so it's really not in some of the people's hands that you think it is. I think it has to go in front of a very political process before you get to an answer. Okay, next slide. Now I did it too. Okay, and then there's this. Sheila Bair comes out with this statement. Clearly there's a strong correlation between the amount of skin in a game a borrower puts up front and how the loan performs, and it's only common sense. Did you put 20% down, you're committed to that house, you walk away from the house, you're going to lose a lot of money that you put up front. In other presentations, we've shown that that's not a true statement, that there's virtually no distinguishable difference between the loan performance of a nothing down loan called VA, an FHA 3% down or 20% down loan for 50 years until you got to the funny games we played in, say, 2002 and beyond. Yet, because of people like this saying this, there's documents now and going to become law unless something gets in the way of it, to where 20% down will be the gold standard for the best interest rates, and you won't be able to get that without 20% down. You know, talk about perfect timing to tighten the reins in. When it's most affordable, they're making it the least likely that someone's going to get a loan. And then all the verbiage is really about discouraging people from even pursuing home ownership. Here's one of the main reasons why ownership has to go down. This is Hesperia, and I chose this particular chart because it's completely awful. And it exaggerates the point, but it is a constant everywhere that we have negative equity. This is 9,094 households that owe twice as much as their property is worth. That's what that scale means. And then 5,793 only owe 120 to 200%. When you get down to it, 76.9% of the owners in this area aren't going anywhere. They're not going to buy another house. If they continue to make their payments, they're going to just stay there for a very long time until their house doubles. Or they're going to let the property go, be a short sale, or be an REO, and that'll put them out of the buying business as well. So Hesperia's got a ways to go before it gets well, but they do sell these properties at quite a big discount, and they make perfect sense for an investor. So that's why this is what's going on right now, is you're going to have a shift away from home ownership for a while. The numbers just absolutely demand that's what has to occur. Distressed sales, this is Riverside County. 65% of all of our sales are either REO or short sale. And I looked at this chart probably for 6 months before it dawned on me what the real meaning was. The real meaning is that 650, every time we close 1,000 sales in Riverside, 650 former owners do not repurchase and occupy a residence they own. They become a renter, or they become somebody else's tenant in a room, or they become a tenant. That's never happened before in that ratio. So once again, you have negative equity situation, or you have people selling properties because of duress. They're not going to be an owner, and it creates opportunity for people like us that want to own rentals or want to invest in the trust deeds that fund those rentals. This is a ratio of short sales to trustee sales. Short sales are gaining momentum. The lenders have figured out they get more for a short sale. This is a national picture of where we are. 4,211,000 loans are either 90 days late or already owned by the bank. So that's the total. And on a monthly basis, we solve about 100,000 of them. So if you divide that into that, we're only about 40 months away from solving this thing, if we don't add another foreclosure, okay? So what I'm saying is there's opportunity for us as investors to buy some of these properties at a discount. Okay, next slide. One of the things that's also gone on is people are netting less money. So in the peak of the market, we were walking away with more than $200,000 when we closed the house, and now we're getting 35. So along with the idea of let's be more conservative and get a bigger down payment, people are walking away with less money than ever when they sell. So becoming a repurchaser of a house, if they have their way, is going to get more and more difficult. Next slide. So what's the solution? These are things that have been talked about. Debt forgiveness. Do you just take the principal balance and reduce it? Probably a bad idea, and that's probably not what's going to happen. You have a foreclosure moratorium. Well, in essence, that's about what we've had for the last year as we went through MERS and robo-signing. That didn't solve anything. Maybe we should just foreclose on them. I mean, honestly, if somebody hasn't made a payment for 2 years, I think they've stated their intention, and perhaps I think we're going to get to that the next year, that we're going to foreclose on many more properties. And a solution would be to get loans for investors. I really think there's no danger in loaning to investors at this point, but Fannie Mae and Freddie Mac have policy problems inside, where they can't just do what makes common sense sometimes. So I don't know that that's going to happen overnight either. Next slide. The current investor programs, you can get 10 loans. A lot of the people that we deal with on a regular basis own more than 10 homes. They own sometimes more than 10 homes out of the state of California. They would love to 1031 exchange back into California. They can't get a loan. So they're trapped wherever they are. So these policies really do have some ramifications. And so a few years ago, 2 years ago exactly, we decided to become part of the solution, and we started loaning investors money with an 8-year program. And it was very successful. Let's go to the next slide. So this is our program for loaning to investors. It's at 9.9% interest for 8 years, interest-only payments at 60% LTV. And this round circle shows that every one of those loans is current. 197 loans funded, $15 million of loans. And I brought that chart to Fannie Mae and FHA and showed them that, because they're worried about loaning money to the wrong people. Our clients actually make their payments, and they're astonished at the 9% interest being okay, but it makes sense. We're buying these properties at such a discount that the numbers still work. Whoops. Okay, this is a typical transaction that we see on a regular basis. The former price in 05 was $450,000. It was listed for $174,000 in 08, and January of 09 it was reduced, and it was reduced again, and then finally sold in September. And one of the things that happens sometimes as REOs sit is they don't improve in condition. This one apparently didn't improve at all. As a matter of fact, the city condemned it, and it had code violations. And so the investor buying this knew what he was doing, did the repairs. The city was happy that he showed up. He bought the property for $82,000. So the lender who was owed $450,000 got $82,000. Sounds like a good deal. And put in $30,000. And it's a 4-bedroom, 2-bath, 1,300 square feet. And a lot of the rentals will be, it's the same house. Normally we don't end up with 3,000 square foot rentals that are built in 2005. This is more common. Single story, 1,500 square feet, that's very common. Next slide. Okay, currently what we do with the loan program is they own the property free and clear, they fix it, then they come to us for a refi. So they have $112,000 into this. We lent them $115,000, but it's based on an appraisal of $196,000. Okay, so there's about an $80,000 equity position. It's rented for $1,500. And I think what's interesting about every one of the loans that we do is you could understand why the investor wants to be in that situation. I wouldn't mind buying a property where I ended up with an $80,000 equity position and a positive cash flow. So I would willingly sit on that side of the table. I would also willingly sit on the side of the table that loans them money at 9%, at 60% of value. I don't see any unwise decision in either one of those scenarios. And that's what's unique about right now, is the smart money is on both sides of this table. Next example. This was a sale that happened in November of 06, $392,000. List price $89,000. The dates are wrong here, I noticed that. This sold fairly quickly for $92,000. It was listed for 2 days. It closed escrow in 36. It needed $17,000 repairs. Built in 57, 4-bedroom, 2-bath. I mean, it's almost the same house as the other one. After getting it rented for $1,500, they did a refi at $102,000. It appraised at $170,000. And so somebody's collecting rent in excess of their payment, and somebody's collecting interest on their trust deed. I took a vacation recently, and it was very interesting watching the mood of some of the people on the trip, because they had stock investments and I did not. And I enjoyed the trip a lot more than they did, because it happened to be when it really hit the fan. It was one of those times where the stock market gyrated 400 points a day either way. And I don't care which way it goes 400 points. If you hold stocks and it does it over and over again, back and forth, you're not very comfortable on your vacation. And that's what happened. And I remember thinking, when I get home, what I'm going to have is rental checks and trust deed investment checks. And nothing will have changed in my world. And it felt very good. Next slide, please. And some of the choices, I mean, I think about what most normal people would look toward would be the stock market or T-bills. And when Greece, was at its worst, the 10-year T-bill was 1.75. Now it's all the way up to 2.3 or 4. That's not a very good yield, And you could participate in the stock market, but I think most people find that to be a pretty uncomfortable experience. So I just think the niche that we have, owning rental properties or trust deeds, is really one of the safest and best ways to go. One of the things is just simple. We understand the concept. All of us have borrowed money and made a payment to a Bank of America or a FHA. We understand the concept of a first trust deed. You can visit the asset. So I don't have to invest in some weird thing that's, in another country. I can go and say, okay, do I want to make a loan of $60,000 on a $100,000 house in Hesperia, and I can go visit the property and stand in front of it, and this is what I would ask myself. Do I mind owning this for 60 grand plus closing costs? Because that's my downside risk. I'm going to get paid 9% interest on a 60 grand trust deed, or I'm going to own what's in front of me. If either one of those are okay with me, that's what I mean. I think we can understand that concept. We can visit the asset. You can know that the borrower has skin in the game, or they've had skill to put an equity position of 40% in between you and what the property is worth. And frankly, I don't care how it gets there. I just know having a margin of equity is important. And if it got there by the skill of the buyer, and in most of the cases that's what happens with our clients, they buy these properties below market because they need work. And they do the work, and then all of a sudden we end up with a good trust deed. And the borrower has a profit motive. And a little later on we'll talk about who we loan to. But one of the funny things is most people think that loaning to an owner-occupied is a safer trust deed, and it isn't. If we were loaning people at 9% interest owner-occupied, wouldn't there be a problem? When a 4% environment, you'd go, okay, well, you can't get a loan from anyone else for a wrong reason. We understand why you can't get a loan as an investor from anybody, but it's unfortunately, it's not your fault. It's policy. One of the things that happens every day is we get phone calls, and Craig will ask, is the property going to be occupied by the owner? And who's ever answering that honestly thinks that's perfectly safe to say yes to. And they'll say, yeah, they're going to live in it. And then Craig will say, we don't make loans to owner occupants. Oh, no, they're going to rent it. That's the next sentence. And you're going, sorry, the cat's already out of the bag. That just happened yesterday, but it happens a lot because people think that, of course, a lender would rather have an owner occupant be in the house. No, it hasn't worked out that way. Next. So your worst case scenario if you're a lender is you take back a property. So the cost of a foreclosure. There's a civil code that orchestrates it. Most of the loans that we have are, say, $100,000. So it's a percentage of the loan. And I would say the closing cost for a purchase of a $100,000 home approximates the cost of foreclosing on a $100,000 loan. So it's not outrageous at all. And by the way, the odds of a foreclosure, since we don't have one of them in that program with 197 loans, the odds of you experiencing one would probably be less than 1 in 200. And I just don't see the downside. The other thing is, we go to the trustee sales as a property buyer right here. You have a 60% loan to value going into foreclosure. Let's say you didn't get to the courthouse steps as far as the sale until 5 months passed. So now you're at 65% loan to value. We wish we could buy at 65% of value at the courthouse steps. Most of those properties fly by 80%, 85%. So the odds in this environment of that trust deed getting back to you as an owner, I would say virtually zero. Somebody's going to buy it at the courthouse steps. You're going to get all your interest and put your money to work in another trust deed. So that's the big downside, being a trust deed investor. And some of it seems new to people. It's a very new concept. So when we have people that are normally fixed income investors or stock market investors, there's definitely a learning curve that you have to go through. And most of it is, why is somebody borrowing money at 9.9%? There's some discomfort there. And yet our track record says that we're choosing the right people to make those loans to. The timing of a rental purchase is real important. In 2006, when we literally had a median price that was 10 times our median income. So you make 60 grand and the median income of median price of a house is 600 grand. That's a bit of a problem. And they had negative cash flows. Anybody buying a property in 04, 05, 06 really came under the category of a speculator. We were expecting a price increase, not cash flow. Today's person is very different. They're buying it without a great deal of expectation of a quick price increase. They are buying it because it pays them monthly to own it. That's why they do it. So it's a very different environment. We haven't had this for a very long time. So our numbers now are back to normal, where we have this ratio. Go ahead and go to the next one. This is an interesting area, but it also has duplications in probably Hesperia, Hemet. There's a lot of places that are close to this. This is a report by Cal Poly Pomona that appraises different addresses every 6 months and has for decades. So this isn't a median price or a Case-Shiller index. This is an actual appraisal of an address. And so what I did is I took 4 of properties in Lancaster, Palmdale, and I just added up the prices they appraised for in 1990, divided by the square footage average, and then came out with an $83 per square foot price in 1990. And in 2010, they appraised for $74 a foot. So this Lancaster area went down by 11% in actual price. However, interest rates, if you're an occupant buyer, went down by 60%. 10% was the interest rate in 1990, 4% now. And so when you're physically going to occupy a property in Lancaster, you're saving 11% on price, 60% in interest, and you probably make more. That combined benefit makes your payment 30% of what it was in 1990. But Lancaster and Palmdale has the same chart as Hesperia. The owners are buried in negative equity, and so it creates an opportunity for people that are investors to buy the properties at ridiculous prices, borrow money at 9% interest, 9.9% interest, and have a tremendous cash flow, because oddly enough, rents have not been affected near as much as value. So the values got crushed, but rents have remained pretty stable. As a matter of fact, if you're in the building space, one of the things they're kind of excited about is they're actually going to probably build something called an apartment building, because it looks like the only thing that probably will get occupied in the next few years. One of the things that we tried to also talk to people that make policies is how much better off the country would be if you would let people into home ownership right now. The difference between somebody that owns right now, their payment, and rent is very, very different. And if you're looking at somebody's future, you would rather, I think, own right now, so you could end up having that payment that feels uncomfortable. We all had that experience with our first buy, our first house purchase. You remember, I don't know how I'm ever going to make that payment. And about 5 years later, it kind of approximated your car payment. And you had this thing called equity. That'll happen again in California. And right now, we have a chance to buy these properties way below replacement cost. So this is a very unusual market, and yet all of the policies are really against the owner-occupant getting a large share of that. So it's going to go to investors. And I'm more than happy to take our share of the inventory. Next slide. Okay. Whoops. We might be doing it all together. There we go. Okay, who do we loan to? We just loan to investors. We kind of talked about that. We say no to a lot of people. That's one of the things that if you're investing in our trust deeds, you don't realize what goes on before you get the phone call. So we get a lot of phone calls we say no to. As a matter of fact, years ago, there was a gentleman that we usually supported. If I spoke in front of a club, I would talk to LA Investment Club. He had a loan business in LA, and I would say nice things about his loan business, and I liked the guy, so people went to him. When he moved to Missouri, he basically handed us his loan business and said, you can have all the clients. We couldn't loan to one of his clients. We just have different criteria. There's someone that's very, very well known now doing seminars on TV. So people by the hundreds take his boot camp, and unfortunately our name is at the top of the list as the lender of choice. So we get all these people coming in, and we say no to 99% of them because they don't qualify. So sometimes at clubs you'll see people stand up as a hard money lender and say, qualifying doesn't matter, credit doesn't matter, you know, it's all equity. It isn't at our place, I can tell you that. There's a lot of things, including all the experience we have over the years before we make we put your money to work because we don't want you to have a problem. Okay, what do we loan on? 99% of the time it's a single family home. Once in a while there'll be a triplex sneak in there, and that's pretty much the same rules, so that's fine. But again, you can understand that. We're not asking you to put up money on a second trust deed in a commercial property or let's develop land in 2011. It's pretty boring stuff. It's that 1,200 square foot house in Fontana that rents for $1,500 and you have a 90 grand loan on it. And you can go visit it, and it's just that simple. The protective measures we take when we do the trust deeds, and again, this has come from a lot of experience over the years. We just do first trust deeds. So we get approached a lot of times by people to do seconds, even with great equity positions. It's just been our experience that we say no, that it's an uncomfortable position to be in. So we only do first trust deeds. We check credit history. We're not going to say that we don't loan to people that have a low FICO score, but we're going to make it more painful if they leave the transaction someday. They're going to have more skin in the game. But we do pay attention to somebody's history and the type of credit that they have right now, because we look at that sort of as what are the odds that we're going to get paid. That's the nice thing about a private loan business. It's a lot of common sense decisions. It's not so formula driven that you have to say no to people that would make perfect sense. But if you look at somebody that has $300,000 of credit line and they owe $295,000 on it, and they have $12,000 in the bank, and the house they're buying needs $20,000 to rehab, I don't care if they have a 720 FICO score. We're not loaning that money because I don't know how we're going to get paid, and I don't know how that house is going to get fixed. We don't loan where everything has to go right, because guess what? It doesn't. And that's the other thing about being a property buyer, is that we're in these transactions and we realize, and some people are very frustrated with us. We had an experience not maybe a month ago. Craig just talked to one of these graduates from the Get Rich Quick seminar, and that's really what it is. And the guy was pretty frustrated. He left, and I kind of caught him outside of the door, and I said, I'd really like to sit down with you and understand what your expectations were when you came here, because this is being replicated over and over again. So I sat down with him. I said, what are you being told? And so, he gave me what he was told. I said, if I lent you under those terms, I would be foreclosing on you within 6 months, and all the money you put up would be gone. That is what would happen. And I tried to make him understand that we're trying to prevent you from damaging yourself. So, when we do loans, when you see a loan package, it's gone through that filter of a lot of no's before it gets to a yes. Loan to value, I'm not uncomfortable with, say, 60 to 65%. The cash flow is what is also very important in this 9.9% program. And at this juncture, we're very low in price compared to where we were and probably where we will be someday. But when we're loaning, we have to consider where we are more than anything. So right now our program leaves 40% equity. That maybe they will leave 35% equity if I think we're going to head the other way. And that's a safe margin. There's hard money lenders. We get, there's a lot of competition in our space. So we always get told of people that are cheaper or more aggressive, and I don't care. Because to be honest with you, the people that invest money in our trust deeds are very, very difficult to attract and to keep if you have a flawed process where you make loans that become challenges. You just can't afford to do it. And so we watch out for that money just as if it's our own. And be honest with you, a lot of times it is our own. We invest in this stuff too because it just makes sense. I can tell you right now, the pile of trust deeds I have compared to the pile of rentals that I have, this is hassle, this is boring. And boring is really good sometimes, it really is. Okay. Usually when we're loaning on rentals, they're owned free and clear predominantly. So this person had the wherewithal to pay for the house, fix it out of pocket, and when we refi, they're getting back their cash. So they have liquidity. So that to us is a very safe loan. We usually are dealing with established clientele. So if you're putting up money in our loans and you'll be around here for a year or two, you'll start seeing the same names over and over again. So it's very common that we have people that have borrowed with us for the entire 15 years we've been in business. So it's nice to have a track record with people that you know are going to pay you. Some of the other things that we have is, of course, we have title insurance. So that's not a big deal usually when you're dealing with REOs because they went through the foreclosure process. But if it's privately owned, sometimes there's a lot of things that can come up. And so, but title insurance is absolutely important for you to get when you get when you invest in trust deeds, as well as fire insurance. And we're very careful about the fire insurance that we have people get. The house is going to be vacant. So we don't let them get the cheaper rental policy. And a lot of times that's what they'll try to do because they want to pay $300 instead of $1,200. I can understand that, but the problem is that's really not covered. And so we make sure that it's a vacant insurance policy before we fund. Aaron, what's our time frame? Good, 5 minutes, all right. I think maybe most importantly of all is that we have a very good grasp on the cycles of California. So this is what I've been studying for over 15 years now. And I don't think I've ever seen a time where real estate has been more beat up price-wise or in the media where you could hear more bad news in a 24-hour period toward real estate. This is what happens when people go into escrow for the first time. It's a lot like buying a new car. You drive off the lot and then, man, everybody owns one. It's the first time you've recognized how many people have the same kind of car. When you go into escrow for the first time in your life, for the next 30 days, you're paying attention to things about real estate, and it starts affecting how you feel. So you're into escrow. The first sale, the agent that deals with that transaction, literally gets a call every day from probably every client, holding their hand, trying to get them to the finish line because it's scary out there, all this news about real estate. And one of the things that charts allows me to do is I don't make emotional decisions. I make calculated ones. And unless we're never going to build another house in California, this is the time to get some inventory and to either own the properties as rentals or to be the lender on those, because I think most of the damage in the area that we're buying, as far as the price range that we're buying, is locked and loaded. If it goes down some, it won't be much. And so we just have one of those unique times where we're lending, and we're lending for 8 years, and we're lending at 60% of value today. As that price goes up, that loan to value becomes kind of silly. We don't ever hope somebody defaults on a loan, but if they did and they had the property for 5 years, I doubt that would leave a dent in your financials. You'd probably go, I wouldn't mind owning that property. But never do we ever make a loan like that. We always want everybody to be successful. And we find that most trust deed investors don't want that either. At least the people that deal with us, they just want to check. And so that's what our trust deed investment program is all about. And until Fannie Mae and FHA decide to loan to investors, we intend to grow this fund. Our goal is to have $100 million of investors' money involved in this program. We have the demand for it. We have funded $15 million thus far, and we think that we can grow it probably $50 million in the next 12 months and maybe even the next 12 months after that. So that's our goal. And we're talking to some serious people that have control of some serious money, and we hope that's accomplished so we can all go out and buy. And one of our goals is to turn this into a program where it's for purchase. Right now it's for refi. But if we can get enough money together with our clientele, I'm not afraid of the purchase loan in the buying and hold business at all.
A question online.
A question online.
Yeah. What do you think about appreciation in the next few years?
I think appreciation is going to be mild for the next few years. I don't see, until we get rid of that red ball in the background, there's not going to be a lot of appreciation, but it means there's going to be a lot of opportunity to buy gradually into this process, and get rentals. A lot of times people make mistakes of loading up too fast, to be honest with you. I don't think there's giant urgency to lock and load all the inventory you're going to ever own in the next 12 months. I just don't see it. I think gradual purchases are better. Select areas that you want to own. It's funny, I just saw a bulletin or a fax that Rick Solis is our appraiser. And it's one of the most important factors in the success of our loan business is there's filters of people in between a yes answer, and Rick Solis is one of them. He's an experienced investor. And he sent over a fax talking about this property is old, it's in a bad area, and he said, I wouldn't want to own it or be a trustee owner on it for an 8-year period. In other words, don't do it. And we didn't, because we wouldn't want you to own it for eight years. And that's really what we try to do. We say no even to properties that are in escrow where people have deposits at risk, because we know that the pain of closing that is going to far exceed the benefit of owning it. So that's who you're stuck with. And every time somebody gives us a really hard time or gives Rick Solis a really hard time, 9 months later, we'll hear the end of the story, and we have a client. So Craig has come to me more than once at the office and said, blew a deal, made a client for life. And that's okay with us, because we're really trying to think long term. Aaron, are we taking questions from the audience right now? Okay, you tell me when the time's up. I think that's it for this. I never was able to fast forward this, so. Oh, by the way, there's some testimonials of people that have done this at the website, and I'll open for questions. Yes?
Do you think any of that hidden inventory that we always talk about will be released any time, or do you think they'll continue to control the amount that they release from banks?
Yeah, I think the plan is to control it, because, and what's also funny is people say, well, the banks are too smart to do that. No, they're not. That's exactly why prices went down by 60% in California, is they didn't do it. They had 18 months of inventory within 12 months of the peak, and they were selling things for 15 to 20 cents on the dollar. I think they learned by mistake, and as long as the government's willing to dole out the quantity of inventory piecemeal, they could do other things to solve it, and one of them would be to give investor financing. They may go that route, I don't know. But the problem with investor financing through a standard process, you're still going to have a kitchen. And you're still going to have to close quickly, because the seller wants to get cash without a loan being in the way. So there's always room for a private lender. That's that's interesting. But as far as the inventory, I do think it's going to be controlled, because it would cause more problems. You have a lot of people making payments on upside-down mortgages. If you had another 10% price hit, I think you'd have a whole nother round of new people not make a payment and say, okay, I finally give up. Okay, any other question? Yes.
What areas are you lending your private money on in California?
San Diego to Bakersfield, I think, is pretty much the spread. And Bakersfield right now, we're only doing the buy-sell inventory, but the buy-hold will get there very soon. Okay? Got a question here and there.
What happens after 8 years?
What happens after 8 years? Well, 8 years was, in my mind, a safe time frame for both the trust-deed holder and the person that owns the property, an exit point. So go 8 years out from now, 2019, I feel very comfortable that there'll be another decision that's positive, either selling it, being able to refinance it. I'm not worried about that, and if everything's gone well for 8 years, I can't imagine somebody on the loan side and the buyer side not being able to work out, well, let's just keep this going. So I don't see that as a big issue. I really don't. I didn't want it to be 3 years, because I would be afraid of that time frame. Having to sell, I wouldn't want to, even though we have a big equity spread, I wouldn't want the owner to be forced in a situation where they might be selling at an inopportune time. Yes?
I've actually noticed in the last couple of months that there have been a lot of articles about foreign investors in the Wall Street Journal and the Financial Times trying to come in and invest in real estate and trust deeds and all of that. Have you dealt with that at all, or is that something that your company?
Yeah, I'm actually pretty familiar with some of the statistics because of all the stuff that I read. So there is this thought that the investors in foreign countries are coming in and picking up gobs of stuff right now. In 1996, National Association of Realtors produced a report and talked about the all-cash transactions in Florida. The percentage was something like 87% of all cash transactions was from foreign owners. They do exactly what we do. They buy, they're momentum buyers. They show up at the very peak of the market and pay absolutely outrageous prices. They own the entire condo high-rises in Florida. My friend's son just bought one to live in. It went for $300,000 at the peak of the market. Now they're selling them for $35,000. No one is rushing in to buy them at $35,000 because it doesn't feel good. See, that's why I like charts. That chart tells me it's time to buy a condo that costs $300,000 to build for $35,000. But no, certainly you have investors that are coming in from foreign countries to buy. They pale in the number that they were at the peak of the market, okay? They're just people like us. They're sitting there biting their nails going, I don't know. The condo they bought for $300,000, they hesitate to buy at $35,000. Human nature. And you have to understand human nature to be a real estate investor.